permeates the Bay Area, and having worked in the industry for so long, I often have friends who live outside of the Silicon Valley call me and ask me to help them demystify the topic of company equity. Usually it's because they're considering working for a startup. I think it's a fascinating topic even for the general public, especially when you have publicity all over the place around Insta-millionaires coming out of Facebook and Google, and you have shows like the Silicon Valley really pumping up this whole idea of that startup lifestyle. And I think it's become relevant beyond just the Silicon Valley, since really the startup culture is everywhere. I mean, you have the Silicon Beach down in LA, the Silicon Alley out in New York, the Hub in Boston, Silicon Prairie in Chicago, just to name a few. There are plenty of opportunities to get in on the equity game if only people knew how. So that's why I put together a primer based on the collective experiences of myself and some of my Silicon Valley colleagues. I should give a quick disclaimer here that I am not a legal or compensation expert in any way. I'm just sharing with you what I know so that you have some basis for understanding how these equity deals work. In order to talk about equity in any way, shape, or form, we have to start with some basic terminology. So let's start at the very high level with stock grants. This is when you are just given the stocks outright. And whatever the value of the stocks are when you sell them at the end is what you end up pocketing. This is really only common at very early stage startups when you are coming in as a founder or as a founding employee. The other more common type of equity compensation are stock options. And this is usually what mature companies, which are either startups that are in their later stages or companies that have already gone public or IPO'd, generally tend to give out. Stock options are just the right to purchase the stock at a particular price, which is called the strike price, or otherwise called the exercise price, because that's what you're going to exercise the options at. You don't outright own any shares until you have decided to trigger that option. So for example, if you have vested 100 shares of stock and each share was worth about $10 on the fair market and your strike price was $5 per share, then you would end up pocketing that other $5 per share. And that would make your total value of your compensation $500. People like stock options because they're very, very flexible. You are under no obligation to exercise the options. If at the end you decide that the strike price ends up being more than what the value of that stock is worth, you can decide to just walk away. There are also restricted stocks. This type of stock grant became a lot more common after the stock options backdating scandal that rocked the Silicon Valley in the early 2000s. And it forced a lot of companies to become much more stringent with their stock compensation. They are an outright stock grant, but come attached with some conditions upon which the receiving party must fulfill before they're allowed to own the stock. The most common condition has to do with vesting, and this is just the process of earning the shares over a set period of time of employment with that company. The vesting schedule lays out for you the exact dates of employment upon which each portion of your stocks are going to transfer over to you. A very common vesting schedule is actually over 4 years, with each quarter of your stocks transferring over to you at your yearly milestones. And by the way, this is also very common for stock options, where you will see a quarter of your options going over to you on a yearly basis. In order to give financing to a company, investors such as VCs and even employees like you who are receiving payment in the form of equity need to know what the company is worth. You do this using something called a valuation of the market capitalization, or essentially evaluating what the market values the company at. The formulas for calculating valuation are actually quite complicated, but they do take into account things such as what is the potential of the management team, what are the future earnings of the company, and even what investments have previously been taken in past financing rounds. This is also what they base the current par value or face value of each share of stock. For the purposes of figuring out your equity compensation, the easiest way to do an assessment of a company's valuation is by taking a look at their accumulated funding to date. This is because VCs are much smarter than we are and have already figured it out for us. In order to get to this data, I would recommend that you look at a site called Crunchbase, which compiles statistics on tech companies, including any publicly available information on funding rounds that they have received. Dilution. With each round of funding, your ownership in the company is going to get diluted. What this means is that as an absolute number of shares, your number of shares stays the same. However, the percentage ownership that you have in the company is going to get smaller and smaller. So let's take an example. Let's say you're at a party and they order a pizza and cut it into 4 slices. Currently, you own a quarter of the total pizza at the party. But as more people attend the party, they order more pizzas. Pretty soon, they've ordered 5 pizzas. Now, your 1/4 slice of pizza actually only represents 5% of the total number of pizzas there at the party. Okay, so now that we have a basic terminology in place, let's walk through how you should be analyzing this. The first question you should ask is, should I be taking equity as compensation? The bottom line is 9 out of 10 companies fail, and the likelihood that your equity is going to be worth something in the end is very small. Typically, I don't even take equity into consideration when I am looking at the total compensation package. If it comes through, great, it's a nice to have bonus. I will look instead at other non-tangible benefits, like, is this the type of work experience that I want? Do I want to work with this management team? Is this an industry that I want to pivot to? If you're at an early stage startup, the salaries are typically very, very small, and so these intangible elements become quite crucial. However, if you're at a later stage startup, the salaries start approaching industry norms, and you tend to have more cushion from which to negotiate a better cash position. Once you've decided to take equity, how much equity should you expect to get, or should you be asking for? The first rule of thumb is to always work as a percentage of the total valuation of the company. There's a tendency for most employers to offer you stocks as an absolute number of shares. For example, 50,000 shares. This really doesn't help you. You don't know whether 50,000 is a large portion or a small portion of the total number of shares in the company. This directly affects the valuation of what you own, both now and in the future. Additionally, it's also best to know the percentage on a fully diluted basis, and then that way you understand how many shares are going to be issued in the future. Not all employers are going to be willing to work in percentages, especially as it tends to reveal sensitive information around the number of shares that they've issued to date, as well as what they estimate the valuation of the company to be at. However, keep in mind you are entering into an employment relationship with this startup, and it really should be built on mutual trust. How they handle this equity conversation may be indicative of how willing they are going to be to share this type of information with you moving forward. The second consideration is to factor in at what stage the startup is at. Generally, the later the stage of startup, the smaller the percentage of equity you're going to get. There isn't really a hard, fast rule around the percentages, but what I have typically seen is at an earlier stage startup, somebody who is coming in as a senior employee, so a VP and up, making very strategic contributions, is going to get somewhere around 10 to 15%, while a more junior employee is going to get somewhere between 2 and 5%. When you move to a later stage startup, these companies are more mature and probably have taken one, if not several rounds of venture capital funding. So the equity percentages dip dramatically. Generally, I've seen VPs and above senior employees to receive somewhere between 0.5 to 1% equity in the company, while if you're coming in as a junior employee, you're generally getting less than 0.1%. This is because at a later stage startup, your risk of dilution is much smaller, and so this is reflected in the amount of equity that you're going to get. How is the value of a share calculated? First, don't use the on-paper par value of the share. For tax purposes, a lot of companies make this a very small number. I've seen before 0.001 cents per share. The share value actually should be based upon the company's market cap. So the simple math is to take the valuation of the company and divide it by the total number of outstanding shares. The strike price is also a good indication of what the current value of that share is at right now. However, you're probably more concerned with what the shares will potentially be worth in the future when you cash out. Well, there isn't really a good answer for this, and you're probably going to just have to use your best judgment based on information that you've collected. Do you think it's going to grow at 1x, 3x, 50x, 100x? I would take a look at information such as who is your management team and what are they capable of? How long has it taken this company to ramp up development of the product? Are they break even yet? How many rounds of financing have they had to take? And how much have they been able to raise at each round? Who are the competitors in the industry and how are they doing? So let's go through the mechanics of purchasing and cashing out your shares. So first of all, triggering any stock options. When you're at your company, so long as you vest that option, you can trigger that option at any time. However, if you're going to be leaving the startup, you're only going to get a limited amount of time, somewhere between 30 and 90 days, in which to trigger any vested options. Note that any options are going to require you to make an initial investment, which is essentially the strike price that you're going to pay in. So this could be really a large number if you have a large number of shares that you're looking to purchase. The thing to keep in mind is that some private companies actually have quite a long horizon for you to hold on to these stocks, so you may not be able to sell them for a very, very long time. This may happen when the company either goes public, sells itself to another company, liquidates, or decides that it's going to buy back those shares from you. I think there is nothing more fun than working for a startup. It's got a really great energy behind it. However, make sure that you're going to negotiate for yourself a fair compensation package with equity that is going to properly reflect what you're going to bring to this company. Good luck and happy negotiations.